Hello and thanks for joining. My name is Marcelo Bermudez. I'm the Chief Executive Officer of Shokunin. We are a capital access and strategic planning agency working across the capital stack from debt to equity for commercial real estate, commercial business, as well as renewable energy. Today's topic is about the types of capital that are available for commercial real estate. This is a question that we get asked a lot, and so we made this short video for you to understand the pros and cons and what's available for you. Oftentimes, we have clients who come to us and want to get the best rate. We have to ask a lot of questions and understand the why, because capital providers, when they're going out and raising money, they can offer multiple rates, different types of terms, and types of capital to meet your goal based on what it is you're trying to do. Our value add as advisors is to ask those questions to make sure you're getting the best type of product available. And so one of the questions that we want to understand is, what are you doing? Are you chasing yield or are you cutting coupons? Now, cutting coupons is just like a treasury bond, right? You're just hoping to make sure that you're not trying to risk your capital as much as the next person. You want to make sure that not only is the capital returned to you, but you would like to have a return on it as well. This kind of floats around this part of the stack here in terms of risk, which is more of a core investment. It's a high quality location, better tenants, it's comparable to a bond investment, and there's not a whole lot of variability. It's not a whole lot of story going on there. As you move up the risk ladder here, you can see that maybe you could still have high quality tenants, but maybe it's not in such a great location, just outside of the urban core, so you're wanting to be paid for that additional risk. And even higher is if you were to really make a business plan where perhaps you are not renewing certain leases with a number of tenants because you want to reposition the property to be a particular type, attraction to different types of businesses, or maybe you're changing it altogether. And so with that comes a considerable capital need beyond paint and carpet. You want to maybe move walls, you are going to have a significant period where there will be no cash flow for the property, and so you need that flexibility not only to make the renovations but also have time to do the lease up. And at the very top is the most risk, which is a ground-up development. And so there's a high variability in terms of what can change between the time that you get your plans and permits in place to the time that you actually unlock the doors and let your tenant. As you can see, we ask also, is it how will you get there? And so based on the property type and the choice of your goal, capital providers will come forward and offer different forms of capital to meet your needs. And as you see here in this triangle of risk, at the very bottom are the most secure, which is the lender. They're normally in first position. They'll get you up to, I would say, 65 to 80% in the market that we are in currently. And because they're more secure, they're able to offer you a much more attractive rate. As you move up the risk, you can deal with a more sophisticated player who can offer you the additional flexibility that you might be looking for with the story that you are putting forward on the property. But of course, they'll want to be paid for that because they are taking increasing risk and expect a higher return. And at the very top is your money. That's the money that is available to you because of the money you put down, or you and your investors put down, that you are trying to protect. So as you look at the types of capital available, the most common that you might see out there is what they call a bridge. Some call it a mini perm. And these are great for properties with a story, which means risk, right? So you're maybe having vacancy issues, you need to make improvements. Sometimes you need to close quickly because you're trying to beat out a competing buyer. They often have an interest-only component to the loan. You're able to add your improvement budget beyond the purchase price into the transaction. And oftentimes they're looking at the property, not necessarily to you and your tax returns. They really want to be assured by the business plan and your experience that you can get to the finish line on it. Rates really vary. It really depends on the market, where you are, the kind of leverage you're seeking. So anywhere from 6 to 12%, 12 to 36 month terms, and usually there is no prepayment penalty. On the other side of that is your permanent loan, which is there's no more story. You've got your property stabilized, it's performing. You normally want a longer term, maybe a fixed rate, and you will, because of that, you will be agreeable to looking at what is called a prepayment penalty or yield maintenance, because the lender wants to protect their investment as well. They're not trying to get paid back. They want to ensure they're able to keep that money out for a certain period of time. And oftentimes it's a little bit more invasive. You're going to turn in tax returns. They're going to do a deep dive on the tenants, really take a deep look at those leases. But the benefit is you're seeing a much better rate, a longer amortization period. There's opportunities for non-recourse, meaning that you are not personally on the hook for the loan. But with that, they may require additional reserves to head off any potential unforeseen events down the road. And they'll usually use a higher cap rate in the underwriting, which can sometimes lead to less proceeds. In addition, beyond a bridge, if it's something that is ground up or just really needs some substantial rehab, you may just go into a construction loan. And normally you go after the construction loan when you are RTI, meaning you are ready to have your plans and permits issued. And the pro forma really has to make sense. It can't just be numbers that are pulled out of the air to try and fit an internal rate of return plug. You really are doing some deep analysis on the line item budget, the builder's capacity to actually build or modify the property, doing a deep analysis of market influences. And with that, you will see rates similar to bridge and usually a no prepayment penalty. When you look at CPACE, the Commercial Property Assessed Clean Energy is a great product because of the fact that it's billed as a line item in your property tax bill. It is normally non-recourse. It helps you actually improve your debt service coverage because of the fact that it's not sitting in first or second position behind your bank loan, because it is neither debt nor equity. It's sitting inside your tax bill. It is non-recourse and normally treasury based. These are great for qualified improvements. So if you're doing things to make your property more energy efficient, like installing a new HVAC system, putting on solar panels, reducing water usage with new plumbing, changing faucets and toilets, that kind of thing that would allow you to reduce your operating expenses, you can actually use CPACE to improve your bottom line without taking additional recourse. And finally, at the top of the triangle there of risk, you have your mezzanine, like I mentioned before. These are great for projects that need more flexible capital, and you will see rates 9 to 11% range, maybe up as low teens once you get all the fees involved. And then of course you have your equity. You will see some similarity with the mezzanine and equity is that normally, whether it's a loan or if it's your equity, you are secured by the entity, not the property. And that is really to help you maintain control as well as give assurance that if something does go sideways, a solution can be found. We are here to help. My name is Marcelo Bermudez. I'm a certified exit planning advisor. We provide access to capital, strategic planning for commercial business, commercial real estate, as well as mediation, and we are also a court-appointed receiver for properties that end up having a little bit of difficulty. But our goal is to get you to your finish line. So you're welcome to click on the link here, Meet with Marcelo. That will take you directly to our website to book a meeting. Or if you have your phone out, you can go ahead and scan the QR code and it'll take you to the same place. Thanks so much. We look forward to seeing you soon.